What's good, y'all? Welcome back to the channel. This is our first video of 2026, so you know we got to start it off with a banger. Today I have three topics that I want to go in depth with y'all about. The first is my theme for 2026, which is the graduation from being a consumer to becoming an owner. The second is my personal trading journey in 2025 and all the lessons I learned and the things I did to correct my mistakes. And last but not least, I have 5 stock picks for y'all that I think will outperform the S&P in 2026. All I ask from y'all is that y'all drop a like, subscribe to the channel, and share this video with someone that you want to see win in life. You don't want to miss this, so let's get into it. Now, before we get started, I want to go into our disclaimer. This content is intended to be used and must be used for informational purposes only. This is not financial advice. These are my opinions based on what I see in the market. Please do your own research before making any investment decisions and only make investment decisions based on your own personal circumstances. So now that we got that out the way, let's jump right into it. So first is my theme for 2026, which is graduating from being a consumer to being an owner. And I have an example for you guys that will explain why and why that's so important for 2026. And my example is the big three banks in America. So for those that don't know, the largest consumer banks in America are JP Morgan or Chase Bank, Bank of America, and Wells Fargo. Now, between these three banks, they hold 40 to 45% of all US deposits. So nearly half of all deposits in America are stored within these three banks. But one thing I found out in doing deep dives through these banks is that their savings yields, or at least the rate that they pay you on their saving accounts, is the lowest in the industry, right? So each of these savings accounts pays you 0.01%. And that equates to 10 cents for every $1,000 that you have saved. So you get a fraction of a penny for every dollar that you have saved in their accounts. But the difference between being a consumer and just having a savings account and being an owner or a shareholder is tremendous. So, being a shareholder or a partial owner of a company means that you receive dividends. Dividends are payments that a company makes to their shareholders as a reward for being a partial owner in a company. And their dividend yields are significantly higher than their savings rates. So, JP Morgan has a 1.8% dividend yield. Bank of America has a 2% dividend yield, and Wells Fargo has a 1.9% dividend yield. So, what does that equate to? So, instead of receiving 10 cents for every $1,000 that you have saved in their bank accounts, you will receive $18 for every $1,000 that you have invested. That's a 180 times increase from their savings accounts. Now, you might be thinking 1.8% still isn't a lot. And you would be right. But compared to a savings account, it's significantly higher. And the more money that you have, it doesn't stop at $1,000. The more money that you have invested, the more dividends you'll receive. But the other thing about being a shareholder is you don't just get dividends, you also have equity in the company, and that equity appreciates over the time as the company does better. And each of these companies had monster gains over the past 5 years. So looking at the 5 year performance of the stocks of each of these companies, JP Morgan has increased by 130% in the past 5 years. So you would have more than doubled your money by investing in JP Morgan 5 years ago. Bank of America has increased by 70% in the past 5 years. Wells Fargo has increased by 177%. Now, on the low end of that, if you invested in Bank of America 5 years ago, you would have gotten a 14% annual return. A 14% annual return is 1,400 times higher than you would have gotten leaving your money in a savings account with Bank of America. So basically, as a shareholder, you get paid twice. You get dividends and you get equity in a company that appreciates over time. Now, what is the lesson in all this? The lesson is that the owners get the real money and the consumers get the scraps that are left over. And the reason being is that we have to be realistic about the fact that we live in a capitalist society. What that means is that public companies have a legal obligation to act in the best interest of their shareholders, not their customers. So always remember that if you are not a shareholder, the company does not have a legal obligation to act in your best interest, which is why it makes sense for us to become shareholders of these companies. We're not just giving away our money to these institutions anymore. In 2026, I want us all to make a stand and receive ownership in the companies that benefit from our money. And that way, if we're a shareholder, when they win, we win as well. And in 2026, it is imperative for us to own assets. If you don't own assets in 2026, you will be left behind. And I don't say that lightly. I'm not trying to scare anybody. I'm not trying to be, a doomsday pusher. But what I am saying is that we're seeing a shift in the world. The US government has $38 trillion in debt, and that number is not going down anytime soon. So it's imperative that we own more assets other than just having dollars, right? So I hope you guys take away that being a shareholder is much more beneficial than being a consumer. And that's not to say that you shouldn't have money in these banks. What I am saying is that you shouldn't only have money in these banks. If you believe in these companies and you trust them enough to house your money and to store your money, then you should also trust them enough to invest in them and be able to reap the benefits of their growth as well, right? So, that leads us into my second topic of the episode, which are my personal lessons from 2025. Now, 2025 was a roller coaster for me, to say the least. I lost a lot of money, but then I also made a lot of money, lost some again, made some back. Um, and let me just break that down for you. Let me paint a picture for you guys. So, coming into 2025, I had just got my bonus from my job, and I had been studying options for about a year or so. So I was expecting to come into 2025, hit the ground running, and just rack up money. So I took a chunk of my bonus to, pay off some credit cards, and another chunk I put into my brokerage account. And I had been doing research for months. I had already had my companies picked out, and I bought options contracts on three companies. Those three companies were Vertiv Holdings, AMD, and I believe the other one was Arista Networks. Vertiv Holdings and Arista Networks were AI infrastructure companies, and AMD is a semiconductor company. All three companies did amazing in 2025. They all had great gains. The reason that I lost money is, well, a few reasons really. The first reason is I didn't have a system. When I say having a system, as a trader, it's very imperative that you know what type of trader you are, and then also what your system is to take trades, what your system is to take profit, what your system is for your stop loss. A stop loss is basically showing that if your option contract dips below a certain dollar amount, it'll sell your contract automatically. The reason that's important is because in option contracts, unfortunately, you are at risk of losing all your money. So a stop loss really puts a cap on your losses. That way, if it goes below a certain number, it sells automatically and you don't have to keep watching the charts 24/7. And I didn't have a system for what my stop loss should be. So some of those investments lost more than 50%. Now, my personal stop loss system now is 30% for short term contracts, 35% for longer term contracts. And that way, when I see the number hit on my account, I don't even have to hesitate. I know that it's already going to sell and I don't have to think about having to lose money. So, one reason is that I didn't have a system. The second is that I wasn't mentally prepared to handle wins and losses because at this time I had both. I wasn't prepared on how to handle the losses and be able to cut my bad trades early and not wait too long, but also to not cut my good trades too short. And also not to let my good trades end up turning bad and let them stay longer than they need to. So being mentally prepared was vitally important. And lastly, my skills weren't fully developed. I said I had been trading for about a year coming into 2025, but it typically takes about at least 3 years to become a profitable trader. And so I really studied other traders and how long it took them to be successful. I talked to a lot of traders this year, especially at InvestFest, which I went to back in August, and they all had the same consensus that, it typically takes 3+ years to become a profitable trader. And I just went in guns blazing thinking that I was gonna, take the market by storm, but it's not always that simple. So, what did I do to correct my mistakes? The first thing I did was I built up my long term account first. I told myself that I couldn't take any trades until I got my long term account to 10,000. Now, 10,000 was a very important figure for me because that creates a lot of compound interest over time. I knew that if I got to 10K, that if I did nothing else, for the next 5, 10 years, that I at least that's a good foothold to increase in value by a significant amount over a long period of time. By long period, I mean at least 5+ years. So it was imperative that I got to that number first before I started making any trades. And while I was doing that, while I was building my long term account, I went back to the drawing board. So I started studying things like market psychology. I went deeper into studying technical analysis so I could help build my system. And also I started leveraging AI to, fill in my gaps. The reason the long-term account was so important was because um, it long term wealth will always supersede short term gain, right? It's always important to have a long term foothold first because those are things that will increase in value over a long period of time and build compound interest. The short term gains will come here and there, but they're really not what makes you wealthy. It's the long term gains that stand the test of time, and that's how Warren Buffett made his money. So that is critically important. And the most important improvement that I made this year was market psychology, right? So I read this book that I have here, and I highly recommend anybody read it, whether you're trying to trade or not. And that book is Trading in the Zone by Mark Douglas. That book completely changed my perspective, not only on trading, but on life. And the reason being is because even though it is catered towards traders, the book is basically about how to recognize your flaws and recognize how those flaws play a factor in being a successful trader and how to overcome them. Because a lot of times, as a trader and in life in general, we choose to overlook our flaws. And by overlooking those flaws, they end up constantly having an effect on our performance in every aspect of life. Whether it's our job, whether it's trading, whether it's our relationships, platonic and romantic. So we really have to look inside ourselves and recognize the things that we don't do well. And when we see them in the future, like correct them and look back and say, hey, I did this before, didn't work out so well. This is what I'm gonna do now to make sure that I don't make those same mistakes again. So that book really helped me do that. And just some examples are like fear. Fear is detrimental to a trader because fear will keep you on the sidelines from taking a winning trade and losing potential to lose money. Sorry, you miss the opportunity to make money, but also fear keeps you in a winning trade too long and turns your gains into losses because you're fearful of missing out on more money that you can make. So fear is another big one. And trading really shows you who you are as a person. If you're very arrogant and egotistical, that will come out in your trading journey, and you will lose money. If you're very passive and very timid and very fearful, that will come out in your trading journey. If you are, impatient and you rush into things a lot, that will come out in your trading journey, and you will lose money. My personal fault was that I was disorganized, and that goes back to me not having a system. you know um Once I really put my system on paper, wrote it down, and whenever before I took a trade, I have a checklist that I go through, and at least 3 of those boxes have to be checked for me to take a trade. And once I did that and I actually put it on paper, it took out all the worrying that I had to do. I knew that if a trade hits these marks, I'm gonna take it. If it goes up, if it hits this, profit amount, I know I'm gonna sell and I'm gonna take profit. If it dips below a certain number, I know I'm gonna sell and just, cut my losses short. That way, I didn't have to. It takes emotion completely out of the game. It puts a lot of things on autopilot. That way, you can focus more on the technical aspect and not the emotional aspect. And once you take emotion out of trading, that is where the sky really hits the limit. So those are my biggest lessons from 2025, and those are the things that I did to improve. Um, Building a system was by far the most important part of that, and using AI, and that is a lot of things that I will be taking into 2026 so that I can see how they improve my trading journey, and I'm very excited to see how that goes and to share that with you guys. And that leads us into the last segment of the day, which are my top stock picks for 2026. I have 5 for you guys that I think will outperform the S&P. So let's get into them. Number 1 is Goldman Sachs. Goldman Sachs is a leader in the global IPO market system and mergers and acquisitions, right? So Goldman Sachs has a 36% global market share in mergers and acquisitions. For those that don't know, mergers and acquisitions is a key area of investment banking. Mergers is when two small companies come together to form an even bigger company. And an acquisition is when a large company buys out a smaller company and brings it into their own, and they basically take it over, right? Now, to have a mergers and acquisitions, you have to have somebody advise you, and you have to have somebody write up the contracts. And that's where Goldman Sachs shines. So, like I said, they have a 36% market share. They have $1.48 trillion in deal volume in 2025. They earn 50% more in M&A fees than JP Morgan, which is their next closest competitor. And the reason I think they'll outperform in 2026 is because over 200 companies are projected to IPO next year. And you can bet that Goldman Sachs is going to be participating in a lot of those. Some of those are expected to be some of the biggest IPOs in history. Those include OpenAI, which is the company behind ChatGPT, and SpaceX, which is Elon Musk's space exploration company. Both of those are expected to be valued at $500 billion each. um, Anthropic is another large language model that's expected to go public, valued at over $150 billion. Goldman Sachs will play a part because in 2025 they advised on 38 of the 68 mega deals valued over $10 billion in 2025. So Goldman Sachs will definitely play a part in how that IPO market plays out in 2026. So you can bet that they will do well. My number four pick is ServiceNow. ServiceNow is one of the leading enterprise software companies. Basically, they help companies create AI workflows, and help automate certain mundane tasks. Now, the reason I think they would do well is because companies don't want to completely scrap the software they already have. They want software that works with the data they already have in house, and ServiceNow does exactly that. Um, AI use in corporate environments is the most tangible revenue stream for AI right now, and I think ServiceNow will be a big beneficiary of that. They are on the path to reach $1 billion in annual AI revenue by the end of this year. They have a 98% renewal rate, which they have a subscription model. So once companies sign up for their services, 98% of them renew their services, meaning they have consistent revenue, and they work with 85% of the Fortune 500 companies. So they really are the go-to option for enterprise AI. They're currently trading at a premium right now of 40 times earnings, but the stock is down 40% from their all-time highs, making it very attractive. We know the game of investing is buy low and sell high. Right now, ServiceNow is low, and I think they will continue to do well. My number three pick is GLD. GLD is a gold ETF. Gold had a monster year in 2025. Gold was up over 60%, its best year since 1979. And there are three things that are backing gold continuing to do well. The first is rate cuts. Rate cuts make bonds less attractive. Um, as the Fed continues to cut rates and lowers the interest rates of bonds, which are typically supposed to be the safe haven investment, once they become less attractive, the next logical thing to put your safe money into is gold. And we saw a lot of that. The Fed cut rates three times last year. The next is dollar devaluation. We have to remember that gold is denominated in US dollars. And in 2025, the US dollar lost 10% of its value in a single year. So as the value of the dollar goes down, that means it takes more dollars to purchase the same amount of gold, making the value of gold go up. And lastly is central bank hoarding. So gold held by central banks. So just like we have our Federal Reserve, other companies have one as well. Other countries, sorry, have one as well. Gold held by central banks exceeded U.S. Treasury holdings for the first time ever. That is a major shift, showing that other countries around the world are losing faith in the US dollar. And the next logical thing to go to is gold, which is one of the last pure sources of wealth, pure sources of value that we have in our world. Gold has been used as currency for centuries. So whenever people lose faith in one fiat currency, they typically run to gold, and we're gonna keep seeing that trend continue in 2026. My number two pick is Amazon. Now, Amazon was my top pick of 2025, but tariffs really hit them. They get about half of their products from China. So once those China tariffs hit, Amazon got hit hard. They only gained 6% in 2025, underperforming the S&P. But I think that's why they will do well this year. So just a couple things that we should know about Amazon. Amazon Web Services is still the largest cloud service provider. Their revenue just increased by 20% last quarter, which is the largest jump since 2022. Their advertising revenue was over $70 billion in the first 3 quarters of this year, and they still have Q4. And the reason being is because Amazon owns Amazon Prime. So, they're showing NFL games. They have the streaming network. Amazon also owns Twitch. So think about big streamers like Casanat, like Speed, like gamers and so forth. So they own that market. They also have ads on the actual website, Amazon.com. So advertising revenue alone is a revenue monster, right? The big thing that I think is the big factor in Amazon doing well is they have 1 million robots currently operating in their factories today, right now, at this second. And the reason that's so important is because that means Amazon can process more orders at faster speeds, and they can process more orders without hiring more people. Not having to hire more people means your expenses go down. Processing more orders means your revenue goes up. More revenue with less expenses means you have more profit. And that's something that we call margin expansion. So once we see that, I think Amazon will skyrocket this year. And they're also pretty cheap compared to their competitors. Amazon currently trades at 34 times earnings, well below its historical average of 50 times, meaning it's below its typical value. I think Amazon will do extremely well this year, and they would have been number one if not for my top pick. My top pick this year is Alphabet. Alphabet blew it out of the water last year. They were the best performer of the Magnificent Seven in 2025, up 62%, the highest performer of any Magnificent Seven stock. Their AI overviews now reach 2 billion monthly users. They have a $155 billion backlog. That's revenue that they haven't even counted yet, but it's coming in the future. That's up 82% from the prior year. And they just had their first $100 billion quarter in history. Now, Google was expected to be taken out because OpenAI was people thought OpenAI was going to kill search, but they proved that why that wasn't accurate. AI relies on data, and nobody has more data than Google. In fact, I had to stop saying Google. Google is under Alphabet. Alphabet is the only company that has their hand in every single aspect of AI. Now, what do I mean by that? They have Gemini, which meaning they have their own large language model, so you don't have to rely on ChatGPT or Claude for their large language models. Gemini is also right now rated as the top large language model, even above ChatGPT and Claude. They also own Google Search, the largest data inventory of any piece of software. They own YouTube, the largest media company like in the world right now, the most used app in the world right now. They own Google Cloud, which is the third largest cloud service provider, but is also growing the fastest. Their cloud platform was up over 40% last year. And they own Waymo. Waymo, the self-driving car company, they own at least 80% of Waymo, and Waymo is expected to be valued at $100 billion this year. So that alone, Waymo is expected to lead the charge of autonomous driving in 2026 and beyond. So they own every stack of every stage of the AI stack. And last but not least, Alphabet, is one of the biggest investors among public companies. They invested in Waymo, which I just mentioned, but they also invested in SpaceX, Elon Musk company. SpaceX is expected to go public this year, valued at $500 billion. Google's piece of that will be valued at over $100 billion. So that's going to skyrocket their net income when that's reported. That's expected to come by mid-2026. So Alphabet is expected to have another monster year. So just to recap, my top picks for 2026 are Goldman Sachs, ServiceNow, GLD, which is a gold ETF, Amazon, and my top pick for 2026 is Alphabet. So that concludes the episode, ladies and gentlemen. I hope my personal lessons were very helpful for you guys. I hope this helps you understand the importance of graduating from being a consumer to becoming an owner. And we will return in January next year to see how my 2026 stocks pick did. And this concludes the episode. So stay informed and stay invested. I'm going to catch y'all next time. Peace.